Good evening, everyone. This is Henry Gambell with SimplerOptions.com, and in tonight's free video I wanted to discuss some of the pros and cons of going naked. So when we're looking at play, Dave and Buster's, these guys were up for earnings today, and really just the whole concept of this is that when you come in and you take a look at your options chain, I didn't feel like we had a whole lot of options to try and work our way through, because this particular underlying does not offer weeklies. And that's one of the first things that I look for as I go to initiate an earnings trade, is I like to have those that are up for immediate expiration. That way the vol crush goes right inside with the time decay, and you can really maximize those series. Well, in this case we had good implied volatility. You know, it was 2 times the back month, but it was tricky because you didn't really have a lot of flexibility. One, because there are no weeklies, and two, because you only have $5 listed strikes. So when in doubt, I tend to sell the put credit spread before I will buy the call debit spread, and I thought that made that a pretty easy decision. Sell the at the money put, buy $5 of protection, and you're able to take in $1.81 credit. So if you take in $1.81 of credit, then you have to think about your break even, where in this case that would come in at $68.20. Simply the credit you take in minus that short strike, and that'll give you your break-even price. So $68.20 is where we needed to stay above for this to make money. When you flip back over and see where it's trading here in the extended session, you'll notice how it's pretty much right at that price. So it's not just producing money, but it's not something that I'm going to have to sweat too much. Now, the other part of looking at this, and part of what I've been using this Tastyworks account to try and employ a little bit more of, is to take on slightly more risky positions by selling options like this naked. So on this I was able to come in and sell the $70 put in the exact same series, but by not having that protection contract, number one, I take on more risk, and you have to acknowledge that. But the second piece is look at the sharp difference in the credit that I was able to receive. You know, $1.80 by 340 will make all the difference in the world when you're confronted with a flat open. And same thing here, you can see where that's showing the same price in the extended session. So if I have a $3.40 option, obviously that's going to be much more forgiving as far as my break-even price, and should produce a nice return on the open tomorrow. So I think both are good ways to trade. You just have to decide which of them fits your personality the best, which that you are willing to take the risk on, and then you can incorporate that into your trading as you see fit. So I hope that helps. One other thing that I wanted to make sure that you are aware of is the course that John is going to be doing on this Thursday. This is a completely free webinar on June 8th at 7 p.m. Central Time, where he's going to be covering some of the strategies that he has been using to wire out 2.5% of his account each week. It really is a great method of being able to steadily grow the account and see that net liquidating value continue to rise, while at the same time paying yourself first and being able to enjoy and be productive with the fruits of your labor. So I've learned a lot from the guy. Obviously, I think it'll be worth your time if you get the chance to check it out, and I hope to see you there.